Welcome back to Tax Talk by TNC Sridhar, the channel where we make tax simple, clear, and easy to understand for everyone. In our last episode, we discussed NRI taxation, who qualifies as an NRI, how their income is taxed, and the importance of residential status. But what about those who are working abroad temporarily, say on a short-term assignment, or just moved overseas for a few months? Are they still Indian residents for tax purposes, or do they become NRIs immediately? And most importantly, how are their incomes taxed? That's exactly what we are going to decode today. So let's get started. Many people assume that the moment they leave India for a job, they become NRIs automatically. But in reality, it's not so simple. Under the Income Tax Act, Section 6, your residential status depends only on how many days you have stayed in India, not on your visa, not on your job abroad, or not even your salary abroad. Let's simplify. You are considered resident in India if you stayed in India for 182 days or more during a financial year, or you stay in India for 60 days or more in the current year and 365 days or more in the last 4 years. Now, wherever these days are mentioned, number of days are mentioned, they are cumulative. So, they can be break period, but you take a totality what happened from 1st April to 31st March. However, if you are an Indian citizen leaving India for employment abroad, the 60 days rules becomes 182 days. So, if you worked abroad only for 4 to 5 months and spend more than 180 days in India during that year, you are still considered a resident for the tax purposes. Now, there is also a middle category that is often missed. It's called resident but not ordinarily resident. This applies when you just started working abroad but not long enough to be considered as a full NRI yet. So you will be an RNOR, means resident but not ordinarily resident, if you have been non-resident for 9 out of 10 previous years, or you stayed in India for a period of less than 729 days in the last 7 years. So you'll have to take the cumulative period of stay in India for a period of 7 years. In 7 years, you have been a break period, you are here and there, then the total period working has to be done to get the benefit of that taxation in respect of resident but not ordinary resident. So, in simple words, they are taxed only on the income earned in India or from business controlled in India. But the foreign income like salary earned abroad is not getting taxed. This transitional category that helps employees who are moving abroad for a few years. Alright, now let's look on how your income is taxed if you are an Indian resident working abroad temporarily. If you are still a resident, your global income is taxable. If you become NRI or resident but not ordinary resident, only your income in India is taxable. Let's take example. If your salary is credited in India into your Indian bank account, it is considered earned in India and is taxable here, even if you are working abroad. If your salary is paid abroad from a foreign employer, you are classified as NRI or resident but not resident. That income may not be taxable in India. Now, especially for the people who are going on projects, you go on a temporary project abroad to handle the matter. So, your salary gets credited into Indian account. You may remain there for a longer period, but still your employer is Indian and is paying the money in India. But at the same time, suppose the money is paid in your foreign account, there by a foreign employer, or a foreign agent or to whichever project you are dealing with, then it doesn't get the taxation and you get the benefit of NRI in that respect. Now, foreign allowance and perks received during temporary employment abroad can be taxable if you are still an Indian resident. So, double taxation avoidance agreement helps you to avoid paying tax twice, once in India and again in a foreign country. So, checking your residential status before filing your return of income, first and most important step. Now, the principles of taxation in India is the basis of residential status. Different countries have different concepts. Certain countries have the nationality. Some countries have the principal place of business. And some countries have a source of income. Let us say, for example, USA is having a nationality as a principle of taxation, irrespective of where you are. Suppose Germany has a system of taxing you on the principal place of business. And suppose the France is having a principle of wherever maybe your status, wherever you are staying, whatever you earn in France, you have to pay tax over there. And you happen to be a resident of India. Now let us take a situation of an Indian or an American national who is a resident of India having a principal place of business in Germany and having a source of income in France. Now that income that is earned in France will get first taxed in France by virtue of income that is arising over there. Now the same income will get taxed in Germany because the principal place of business is Germany. And the same income will again get taxed in India because the person is a resident for that particular period here. And the same income is likely to be taxed in America because of the nationality status. So the same income suffers taxation in 4 different countries at 4 different rates and 4 different quantum. This is a hardship because money earned is only one. How can it get taxed so many times? That is why the concept of double taxation avoidance has come into picture. So about this aspect we'll deal in detail at a later episodes. But now I'm just giving you an idea on this point. Now let's talk about some smart tax planning tips for people working abroad temporarily. Track your days of stay carefully. Even if one extra week in India could change your status from NRI resident, which will change your tax liability. Please also remember, because of the difference of time, sometimes you may land up in India, maybe a different date. So that one day will also make sometimes very great difference. So you have to be very careful about, because ultimately the number of days you stay in India is relevant, not what you stay abroad. Okay. Now use of NRE and NRO account wisely. Open an NRE account. Once you qualify as an NRI, interest is tax free. But until then, use your normal savings account. Don't convert it prematurely. Declare the foreign incomes properly. If you are a resident, you must declare all global incomes, including the salary earned abroad under the income tax rules. So, claiming of double taxation avoidance benefits. If the country you work has a double taxation avoidance agreement with India, you can claim relief for the taxes paid over there. Now, here I would like to add further that in some countries, there can be different states, the federation of states. So, each federation will have their own income tax rules. In some countries, each state has income tax. In India, we have got only one income tax all over the country, but it is not so in some countries. Some countries have a central tax, they also have the state tax, and they also have the city income tax. But when the double taxation agreement is there with the that necessarily does not get applied to the other federal states also. So these are finer aspects which have to be kept in mind while working out your liabilities. Don't forget disclosure rules. Residents with foreign assets must report them in foreign assets schedule while filing their returns. To stay compliant with FEMA, that is Foreign Exchange Management Act, and the income tax rules. In this regard, one very important act, there is one act called Black Money Act. This Black Money Act deals with the foreign assets and foreign incomes which have not been disclosed. So there the penalties are very heavy. So you have to be very careful that while filing the returns of income, you disclose all your incomes and all your foreign assets clearly so that you are not exposed to unnecessary perils. Let's quickly recap everything we discussed today. Leaving India for work doesn't automatically make you an NRI. You are an NRI only if you stay outside India for more than 182 days in a year. A resident but not ordinary resident status acts as a bridge between the resident and non-resident India. The residents are taxable on global income, while non-residents and resident but not a resident are taxed only on Indian income. Always use the double taxation avoidance agreement and declare income transparently. In short, your residential status defines your tax world. So if you are someone you know who is working abroad temporarily, make sure to check your residential status before filing the taxes. It could save you from double taxation or unnecessary penalties. If you found this episode useful, don't forget to like, share and subscribe to Tax Talk by TNC Sridhar, your one-step channel to understand taxes in the simplest way possible. Join me next Thursday at 12:30 p.m. where we'll talk about the gift tax and its implications. Until then, stay aware, stay tax smart.